I'm hearing from my clients, people out there saying, hey, there's going to be a lot of renewals coming up, people will start losing houses and things like that. So what's your opinion on that? Because you've been in this for 30 years, you're daily into this, seeing people dealing with issues like that. So what's going on?
Well, I think a lot of the headlines are scaring people, and I think the headlines are wrong. And if you look at the stats on it, if you look at 30-year averages, we average about that kind of 33% default rate. When we say mortgage default rate, that's 90 days in arrears. So that's not foreclosures, anything like that. That's just 90 days in arrears. So about a third of 1% is a very standard kind of level that we look at. Right now, we're at about 0.19. Yeah, we're up this year, but we're up from the all-time record low of 0.14 of 1%. So we're up a little bit, but we're still way below averages. And I think we have to remember when we're talking about mortgage renewals, the stress test actually did its job. I mean, we've talked about this. We had different opinions on it 4 or 5 years ago than we have today, but it actually did its job. So if you look at it right now, a 5-year rate is around that 4.5%. Well, the stress test is at 5.2%. So people are renewing their mortgages below what they qualified for 5 years ago. So everything is still pretty good in the market, and I think to say that we're going to see this monstrous increase in defaults, I think is a little bit misleading. I think we're going to see an increase in defaults, but we're still, I think, going to remain well below long-term averages.
Right. So the sky is not falling on that. And as we said, the stress test did its job, as we didn't like it and kind of slowed down the market.
No, we didn't like it at the time, but it worked.
And now it really sort of justified its existence. So that's one thing. The other thing we want to talk about, because we know that, and I guess also that the people that maybe are in trouble, they can extend the amortization and have different options to refinance, pull some equity, things like that, right?
And I think that's so important that people need to get involved, talk to us, talk to their lenders before they're really up against the wall. Right? There are options available is the message. And, as you said, extend the amortization, things like that, lower the payments. The lenders are working with clients right now. They don't want you to go into foreclosure.
It's very expensive.
It's very expensive. It's a lose-lose for both sides. So pick up the phone and be proactive on those things. Don't wait till your back's against the wall.
Right. So that's, I think we addressed sort of that big one, which I think that a lot of people are expecting, and maybe it's a bit of a false expectation. The second one is the inventory. We're obviously seeing that we had a lot more inventory than we had in the past years. We saw that it was more of a buyer's market in most of the categories, but there was a big change when the interest rates came down, and we saw that the inventory basically was almost got from 14 months to about 8, so almost half of that. And we saw increase from list to sale ratio, meaning that how many actual houses will end up selling from the ones that are being put on the market. And that doubled. It was from 25% in September to over 50 in October. So there was some big signs of that we don't have as much inventory, could get picked up really fast. And when there's not much inventory, guess what's going to happen with the prices?
Prices aren't going down.
That's right. So obviously we don't have the crystal ball, but we're trying to give you as much accurate information. Don't get caught up with the headlines and all the just attention grabbers, because it's not all based on the real numbers.
And you got to remember too, when Michael's talking about the inventory, long-term averages, again, we're in that 10 to 12 months. So we've gone from 14 months down to 8 months. Yeah, inventory's up compared to when we were at 1 month, but 1 month wasn't realistic. That was crazy times, right? That was when, we have 15 offers on every one house. So we're back to a much more balanced market, and that's great. That's good for buyers and sellers.
I agree. And like a lot of and I don't think we will see the craziness we had 2-3 years ago, whereas you said we had almost like 1.5 month of inventory, 10-15 offers, and I literally had to sit down with clients and say, hey, look, this is what it's going to take for us to get your house. We're going to have to look at a lot of houses. We'll write 6 to 7 or 10 offers, and you'll end up paying like 100 to 200 over ask. I don't think we're going to see it next year, but it'll be more of a balance, and I don't think that we're going to see the market, I think the adjustments already happened. We saw.
Yeah, well, if you look at the single family homes last month, they're only down year to date 0.59 of 1%.
Yes.
So that's a flat market. The house prices are holding steady on the single family homes, which I think is fantastic. And I think interest rates, they're like the fixed rates, and again, there's a misconception on mortgage rates. On the mortgage rates, the fixed rates are holding fairly steady. We've actually seen a little bit of a bump up in the last month. But we're basically today, if you look at the bond yields today, we started the year at 3.17. This morning they're at 3.16. So we're basically flat on the year on the bond yields, and that's what drives the fixed rate mortgages. At the same time, the Bank of Canada has been lowering the bank rate, and prime rates have been coming down. We're down 1.25% year to date since June. So we're seeing the variable rates come down, and we're seeing the fixed rates holding pretty steady right now. And I think that's going to continue for the foreseeable future, at least into the short term in the first half of 2025.
Good. So let's wrap it up. I wanted to make sure that if someone's having the mortgage being renewed in the next or few months or coming up, what kind of time frame they should get in touch with either you or another mortgage broker to figure out what needs to be done, and so they're not rushing, because I think some people leave it to last minute.
They do. You really want to be doing this 60 days out, minimum 30 days out, because you want to give yourself the chance to look at it and say, should I be looking at a 3-year, a 5-year? Should I be looking at a variable rate? And not every variable rate is the same. Is my payment locked, or does my payment change as the rates go down? Can I lock into a 3-year or longer fixed rate should 2 years down the road, 3 years down the road, I get worried about what's going on in the market? Do I have those options? Not all variable rates have those options, and it's really important that we look at those and make sure that you've got a plan for the future.
And I guess the other benefit with you've been doing this for so long, you have access to many different lenders. So obviously, if you guys have any questions, Daryl is the guy to talk to, because I get all my questions and my clients' questions answered. So I think if you want to get a second opinion, it's important you get it from someone that has been doing this for a long time, because there's a lot of people that had, from my experience and from my clients' experience, that had not the best advice, and it cost them a lot of money.
Yeah, we try to avoid that.
So what's the best way to reach you?
Pick up the phone, give me a call, 250-470-8843, or email me at Daryl, Daryl, @lendingmax.ca.